You've heard it everywhere, on YouTube, in investing books, even from Warren Buffett himself. The fastest way to build wealth in the stock market is simple. Just buy an index fund and hold. No stress, no guesswork, just track the market and let compound interest do the work. It's a strategy built on the vision of John Bogle, and it's helped millions grow their wealth with low fees and minimal effort. But here's the truth. The same index funds that revolutionized investing may now be creating risks Bogle never imagined. So, in this video, I'm breaking down the unstoppable rise of index funds, the hidden dangers no one's talking about, and when index funds might actually hurt your long-term returns. Let's dive in. First, let's understand why index funds have become so powerful. Index funds were created as a solution, not a trend. Instead of trying to beat the market like fund managers do, index funds said, let's just match the market, and it worked. Over the past 24 years, studies show that on average, 64% of active fund managers underperform the market every year, with 65% underperforming the market in 2024 alone. That's why Vanguard, BlackRock, and other giants have seen trillions flow into passive index strategies. People wanted low fees, broad diversification, and consistent long-term growth, and index funds gave them that. It's no wonder Warren Buffett said low-cost index funds are the most sensible investment for most non-professional investors. But is that still true? Here's where it gets uncomfortable. The very thing that made index funds great, simplicity and popularity, is now creating a different kind of risk. One, market concentration risk. Take the S&P 500. You're told it gives you exposure to the leading 500 companies. Sounds diversified, right? But in reality, the top companies, Apple, Nvidia, Tesla, and so on, make up over 30% of the entire index. That means you're not really diversified. You're riding the wave of just a handful of tech giants. If they crash, your safe index fund crashes too. 2. Passive bubble theory. Some experts warn we're heading towards a passive investing bubble. Here's the concern. As more money pours into index funds, stocks get bought automatically, regardless of how fundamentally strong the company actually is. That can push prices higher even if the businesses behind them aren't performing. Over time, this disconnects stock prices from real value. Now here's where it gets risky. If there's ever a market panic and everyone rushes to sell their index funds and too much of the market is passive, who's actually left to buy those stocks? That's when liquidity can vanish and prices crash fast. 3. Illusion of safety. This is the big one. Index funds are sold as safe, but they are still 100% exposed to the stock market. In 2008, 2020, and even 2022, index fund holders watched their investment drop 20%, 30%, sometimes more, and most didn't have a clue how to respond. Why? Because no one ever told them that passive investing still requires emotional discipline and a plan. Now let's take a look at what index funds get right. And they do get a lot right. 1. They beat the majority of stock pickers. 2. They eliminate decision fatigue. 3. They keep costs incredibly low. And for most people who don't want to think about their money every day, they are probably better than trying to time the market. But there's one thing index funds can't do for you. They don't give you a strategy. You still need to know how much to invest, when to rebalance your portfolio, what to do when markets crash, and how to manage your personal financial risks like building an emergency fund. So when my index funds be the wrong tool? 1. If you need income soon. Index funds are built for long-term growth, not short-term withdrawals. 2. If you're overly concentrated. Many people buy the S&P 500 and think they're diversified, but they forget they're exposed to US stocks. 3. If you want an edge. Index funds give you the average. If you want to beat the market or build wealth faster, you might need to supplement with stock picking, real estate, or other income generating assets. Index fund investing can build serious wealth, but only if you understand the risks, stay consistent, and know where your real edge is. Don't just buy the market, understand the system you're buying into. If you found this breakdown helpful, hit like and subscribe, and let me know in the comments, do you invest in index funds? Why or why not? See you in the next video, and keep investing.